Welcome back. Let's get into conversation with Jignanshu of Bernstein to get a better sense on the stock pressure that we are seeing on Trent today. Jignanshu, hi morning. Thanks for your time today. First up, give us your first take on the performance that we've seen from Trent. 17% revenue growth is what they have reported, but this is slightly under or below what the street was estimating. Your take?
Thank you, Snehi. Always a pleasure. We think this is positive and negative. It is negative because it is the growth expect is lower than expectations from the street, especially given the run up that the stock had seen over the last 3 weeks. It is lower than our expectations as well. But thankfully, the growth has not slid down further than what it did in Q2. It has been sliding scale for Trend over the last 5 to 6 quarters. And we believe that shows that at 17%, we have sort of seeing the bottom or growth rate for Trend, and better base effect, better performance by the company from here on out should help improve its growth prospects going ahead.
Okay, and Jignanshu, I'm just trying to throw some numbers over here. In July of last year, at their AGM, Trent had said that they're aiming for a 25% top line growth. Given the way the 3 quarters of FY26 have already panned out, it means if you put these numbers together, they've done about 14,700 crores of revenue so far in the 3 quarters, which means if they want to log in this 25% growth, they need to do a minimum of 7,300 crores in the next quarter, in Q4. How likely or unlikely do you think that is going to be? And do you think they're going to be able to meet this 25% guidance?
No, I think it's quite unlikely. I think it's pretty obvious from the numbers, like as you rightly mentioned, that 25% growth guidance for this year is quite unlikely. Even for them to achieve a 20% growth guidance, which is sort of the lower range of their medium to long term guidance that they've been talking about. It will take some feat for them to do that in this year, right? It needs almost 30% growth in the last quarter, which is going to be very difficult as well. So yeah, I think it's about resetting expectations that investors have had. That this is not a 25% growth company. At best, we like to think it of as a 20% growth CAGR company over a 3-year time period.
Jignanshu, on the back of that, since you also agree that this is going to be very difficult a feat for Trent to achieve, is there going to be any change in the way you are viewing the stock, your target price? Because you still continue to maintain an outperform with a target price of 5,000 rupees. That's your stance. So any change expected over there?
No, so I think we revised our numbers on Trend last quarter, and we sort of as of now we stand by those numbers that they should be able to do a 20% growth rate over the next 3 years, with another 100-200 bips of profit growth additional on top of that revenue growth, largely driven by operating leverage improvement. So that gives us our target price of around 5,000 for March 27, which we think that they can still meet. We think that while both the price pickup in run up to the quarterly results and the reaction today are both sort of overdone, and we expect that gradually as the overall sort of consumption stabilizes, but more importantly, Trend's growth improves given base effect, given their own initiatives that they've taken at the stores to let go of inventory, to add more stores, and so on. We do expect them to go back to a 20% growth number next year.
Okay, so while that sounds optimistic, Jignanshu, talk to us about what happens to the margins, because given the erosion in top line, despite that, the margins have continued to do very well for Trent. Even in the previous quarter, the margin figure was around 17.2%. What is your outlook on what happens to margins this quarter, given that the revenue growth is also expected at 17%, which was the similar figure we saw in Q2 as well?
Yeah. No, see, we think the margins have peaked in Q2, at least in the short term. So Q3, Q4, we expect the margins to be similar or slightly lower than what we saw in Q2. Their quarterly margins are heavily impacted by how the rental agreements are structured, which have a sliding scale mechanism, because of which their impact on the cost structure as percentage of revenue sort of falls throughout the year, right? It's very high in Q1 and it's low in Q4. Where I think they've really made the change in cost structure is in the employee cost, where they've been able to reduce the number of employees that they need at every store to service the number of footfalls that they get with the advantage of technology, right? Both at the store level and at the back end level. And hence, we think that a margin structure which is current, which is around on a pre-Ind AS basis, which is after rent, around 12% is something which is sustainable.
Okay. And Jignanshu, do you believe there is more room for further EPS downgrade on the stock? Is that something that you're viewing right now?
Yeah, I think on the sell side, we do expect some downgrades to come on the revenue growth, but and with associated some EPS downgrades on the downgrades for 27 and 28 as well. Yes, I would
Okay.
expect that to happen. We don't have plans for it. We retain our target price as of now, but from broad-based street perspective, the miss should trigger some of that potentially.
Okay, so Jignanshu, on the back of that, you did say earlier that the street is somewhere largely trying to digest the fact that this is not a company that grows at a 20 to 25%. It's going to, and it is reported slightly below that. At what point do you think the market is going to fully price this in? Because every time a trend update has come up in the recent past, the stock has seen a beating like the one it's seeing today. So, by when do you think this is going to start getting factored in, or when do you see the tides changing?
I thought that by mid December, we felt that it was at its bottom, right? That the worst case scenario of the stock, where a bottom would not be 17%, but a bottom would be around 15% revenue growth, was priced in. However, the run up to this, I would say the price action today is primarily a reversal of that run up that we saw from around mid December to early Jan. So it's not negative. And that's why I would uh, differentiate this price reaction today with what you rightly mentioned as the price reaction for the previous few quarters.
Okay. And
That
lastly,
this is more a
Jignanshu,
scale back
yes.
of the run up rather than negative reaction. Yeah.
Okay, okay, understood. And lastly, Jignanshu, before we let you go, also throw some light on the store edition pace that we've seen for both Westside and Zudio. And now that there are categories like burnt toast that are also picking up some steam, do you believe Zudio stands at a risk of cannibalization at all, or competition from internal brands itself?
See, I think the management is pretty astute in creating different brands for different consumer profiles. So I think the brand for the consumer TG for burnt toast is fundamentally different from that of Zodio, which again is different from that of Westside. So I would not be too concerned about cannibalization between those three brands. The challenge for the management is to find the next credible large growth vector besides Zudio and Westside. Right, Abantos is too new, so is Zudio Beauty too small. Their lab grown diamond is also too small, not enough commitment in our view. Star Bazaar is a bit ambiguous, what their approach and aggression there is. So I think for the management to go back to even to attempt a 25% growth trajectory, which you mentioned earlier, they need to be able to find a third large sustainable growth lever, which we believe is missing today.
Okay, and Jignanshu, let's talk about the price to earnings. The valuation at which Trent trades right now, close to 90. Do you believe this valuation is fair? Do you believe this multiple stands to be re-rated?
So we think that we value Trent on 27 or 28 multiple rather than immediate multiple. So in our view, we do it at around 55 to 60 earnings of 28 EPS. Right. So that's where our valuation of 5,000 rupees comes from. That our EPS for FY28 is 83 rupees, and our EPS for FY27 is 70 rupees. So it's 70 times 27 EPS and around 55 times 28 EPS. And we believe at that range, at 55 times 28 EPS, it is less than 3 peg, so 2.5 to 2.7 odd peg, which we think is an appropriate multiple for a fast fashion brand which is stable, largest in the country, and has a credible track record of reviving its brands.
So just to sum it up, Jignanshu, do you believe the worst is in the past for Trent? Because you did say that a positive base effect will now start kicking in, given how lackluster this financial year has been. So that's FY26. Now, do you believe the worst is behind Trent?
Yes, both base effect plus their own steps, their strategic steps of cannibalizing their stores, of couple of cycles where weather, etc., sort of was not supportive, geopolitics was not supportive from supply chain perspective. All of those should sort of help have a good effect as we move from Q4 onwards.
Okay, Jignanshu, really appreciate you taking out your time to speak with us and accommodating our request. Thanks once again. It's been great chatting with you.
Yeah, all right. Thank you. Thank you.
Thanks so
Cheers.
much.
Bye-bye.
Okay, viewers, on that note, time to slip into a very short break. On the other side, buy now, sell now will resume with your queries, so stay tuned.